Hey, Tom here, Flip Anything USA. So look, today going to do a review on Ben Mallah, courtesy of the Iced Coffee Hour. They titled Why Ben is Selling His Entire Real Estate Portfolio. I have some opinions on why he's doing that and a lot of the insights, I think, on the problems he's feeling, the headaches he's hurting on. Talk to him. He's, what you see is what you get. I have a lot of respect for Ben, but Ben blew it. He did. I did a video as much called Ben Blew It, because he didn't refi his properties at the proper time. You know, there's a time to refi and a time to sell. And he's really in a point of selling now where it's the worst of times. And we'll talk about that. He basically admits it. The problem is he's talking about, like, you know, he can see the blood in the water. A lot of properties are going up for sale. They're asking too much for him. And guess what? His portfolio, I am sure, is among the ones that are overpriced as well. You can't pencil these high interest rates. And so we're going to talk about that. So I'll go ahead and get this thing started and let's go.
This portfolio is gone and is stable, and it's taken me pretty much as far as it's going to take me. I believe that the market is turning, or will be turning soon. It has to eventually.
It is turning.
And there's going to be some serious opportunities out there. All right? So sitting on all these assets and ain't making me a bunch of money, just a decent return, doesn't pay to keep. All right? Let's cash them in, take some profits off the table, pay down a lot of debt, because you know what? Man, when I don't owe the bank a bunch of money, that's a good position to be in.
And see, he's not in that position right now, so the bank probably doesn't want to loan him any money right now. And I'll talk a little bit about the math on that in a minute, but let's keep watching.
Because they can't wait to loan me some money. And the values are coming. I just hit the fan, the writing's on the wall. Every saying you can imagine, in my opinion, is there. Okay, I'm seeing loans coming right now due in the probably hundreds of billions, maybe. Definitely in the billions. And everybody's trying to sell their property right now. You know why? Because commercial's not residential. Commercial loans don't go out 30 years. All right? 3, 5, 7, typically.
Okay, so what he's saying is true. You can, different parts of the country, they're more friendly to it. I've locked in commercial loans for 10 years. It's less common. They always want to be able to turn it. The other thing you can do, and maybe Ben didn't do this, is that when you negotiate your loan, when you get a loan in the beginning, even if it's 3, 7, or whatever term you got, you can negotiate a limitation onto how much they bump up. So in other words, if rates change drastically, they'll refi you at a higher rate, but with like a 1% or a 1.25% protection. So in other words, let's just say you're locked in at 4, right? And rates jump up to 7 or 8 like they have now. Well, when it comes due, they can only take you up 1.25 above that, and then you're good for another 5 years. It's like anything. It's what you negotiate, and that's negotiable. You know, you're a customer with a bank, and so they want your business, and they'll do what they have to do. But right now, it's a very, very, very tough time. You're not going to get a deal. And the reason you really can't get a deal is because you give somebody a deal, you got to give everybody a deal. Because the banks are, you know, they're overseen by the government, and the bottom line is you can't play favorites, right? You can't play favorites. Discrimination, it opens a big can of worms for them. And so they will have to foreclose on people that don't pay their bills, and they have to do it with everybody.
Maybe you go a little further with 10 if you got some AAA Home Depot like I do, or Lowe's that has a long lease on it and they ain't got to worry about. Typically commercial loans.
Long lease, but typically those have actually a low cap rate.
It's a short time. So that teaser, wonderful, great interest rate we used to have when somebody else was president is no longer there.
Totally agreed.
All right? You're going to have to take today's rates, and the properties can't handle today's rates.
Isn't there a chance, because I thought the same thing, that you're wrong and that they could lower rates just as quickly as they increase them, and then everyone in commercial real estate could get lucky and kind of get bailed out because interest rates go from 7% back down to 4?
It rarely happens. Okay, now it did happen in 2009, right? In 2009, the rates dropped from 5.5 to 2.5 in about 6 months. I had just borrowed $3 million from a bank that's out of business now. I can't remember the name of it now. That bank, and now they're owned by Wells Fargo, they dropped it drastically, 3 percentage points in a very short time. I'm talking about the Fed, right? The Fed did. And I had a rate based on the Fed rate, right? Actually, mine was on the LIBOR rate, which the LIBOR, I don't even think they have LIBOR anymore, but they're like neck and neck all the time with the Fed rate. So basically, within 6 months, I was paying 3% less on that $3 million, saving me $90,000 a year just in interest. Let's keep watching.
Let's just say.
I don't think we're going to see the stupidity anymore of people pushing a button so much. All right, never did I see the rates in my whole lifetime go up so quick, so much. It's not smart to do that. You're supposed to just do things in a way where people don't feel pain.
Yeah, and I agree with him that they should be addressing it more gradually. Rates jumped up quite quickly because they're trying to curb this inflation, but they should have already been going up before that. So it wouldn't be quite so much sticker shock going up so much. Ben's been around a while too, but guess what? Ben hasn't been doing this even near as long as I have. I started in 1981. I think he started somewhere in the early 90s. So what he missed in that 10 years of investing through the 80s that I encountered was I started with interest rates that were at like 12%, right? First and last loans that I got from 81 to 1991. I made my first $1 million in that time period. I was borrowing money at 10% owner carried from the bank, somewhere around 84, 85. I was borrowing money at 9.25%, which was considered a good deal at that time. Still, things were hovering right in there, up in the nines up till about 1990, 1991. Ben never saw the high rates, so I don't think he understood that things can actually go up so high because he really never encountered these higher rates before, or maybe this was the maximum that he ever saw was this, but he didn't think it was going to happen. He didn't refi his properties, and now he's paying for it. And we'll keep watching, but it's a terrible, terrible time to pay for it.
But couldn't you then say if Trump gets elected, he's going to lower interest rates, or at least pressure the Federal Reserve to
I'm
lower
sure it
interest
will go
rates?
that way, whether he does it or not. I mean, I'm sure that the Republicans are always going to want to keep rates low because cheap rates mean growth.
Yeah, unfortunately, half the Republicans in there are rhinos. They're not Republicans. They're self-serving. They don't really care. But like Ben said, we need a businessman. We had things were much greater, much better on the previous administration. But the way we're going to recover from this is we got to catch up. The things jumped too quickly, too fast. So what's going to happen is everybody's going to start making more money. Wages are going to be much higher. You're going to see wages go up, right? Because that's the only way you can counter this. Wages have to go up. So wages will go up, and in time, the wages will catch up with the cost of living, and everything's going to be more expensive, but everything's going to get paid more. So in the end, it's going to kind of feel the same overall.
People borrow money cheap. They do more. They buy more. You make more. And, people spend more. People are working. And it just seemed like a much better world to me when interest rates are lower. I can go out there and, and borrow. Right now I'm paying more than twice the interest rate I used to pay.
Yeah. See, that's the problem. And see, this is where Ben's going to really get hurt. And look, and I don't pretend to know more about Ben's portfolio than I do. But what I can tell you is all these properties, he's seeing a lot more property coming up for sale. And he's seeing a lot more loans being called because it's time, right, for a lot of these people. He smells blood in the water. I do too. But I don't smell my own blood in the water. He's smelling his own blood in the water. That's why he's selling. And this is terrible for him because he, like he said, he's selling his portfolio. And when is he selling it? He's selling it at a time when everybody's trying to sell. So now it's a buyer's market. And so he's subject to what happens to people that are in a buyer's market. You're weak as a seller. He is going to have a rude awakening, and he's already got it. He's doing the right thing. And listen, I like Ben. I wish he would have refied. And he wouldn't be, he might be still in a little bit of this position anyways, but it'd be 2 years from now, and maybe things would be a little bit better in 2 years. I really don't know for sure. I wouldn't doubt if rates continue to climb, to be quite honest, only because I come from a time when I've seen rates at 10, 12%.
Maybe 3 times in some specific properties, okay, versus what I could have locked it in at.
Yeah.
Okay, so he said it, right? What he could have locked it in at. Here's the deal. If you get an idea how painful this is, let's do the math on this real quick. If you have a property, let's say you have 3 properties, one that's completely paid for, $1 million equity, has an 8% cap rate. You make $80,000 a year. Now that's a keeper. You can keep that. You got no debt. You can hang on to that one. Now let's say you got another one, same thing, $1 million, but you owe 50% on it. You borrowed $500,000 on it. Well, and you're paying the bank 4%, right? So you're giving the bank $20,000 a year for that $500,000. So you're still making $20,000 a year on the debt part of it, and then on the part that you have equity in, you're still making a full 8%. So you're making 40 on your equity, and you're making 20 on what's basically the debt to the bank. So you're making 60 on that property. Yeah, that's still not too bad, right? Well, then let's get to another one. Let's say you have another $1 million property and you owe 75%, right? You owe $750,000. Well, you're paying 4% on that $750,000. You're still making $30,000 on the bank's money. You're making 20 on your equity. So you're making 50. You're making 50 on the one that you owe 75% on. You're making 70 on the one that you only owe 50% on. And you're making a full 80 on the property that you own outright. Well, now all of a sudden the interest rate changes. Now the interest rate's 8%. And on the one that you owe 75% on, but you're not making anything on the bank because they've taken it all now because the interest rate matches the cap rate. That's the problem, right? That's the big problem. But of course, the one that you own clear out, you're unaffected. There is no bank. You're making 80 on that one. I think that where Ben's at, it's difficult to even hang on to a property where you have 50% equity if the interest rate changes so drastically. That, in a nutshell, is his problem. The secondary problem that's even worse, let's just say you have 50% equity, but you have a zero basis. In other words, you've been deferring from 1031s that you do, and you've got a property that you basically have almost a zero basis. So you're going to get absolutely killed on the taxes, whether it's when you sell that you have all the equity in, or it's one that you have just partial equity. So that's where it becomes very, very painful because you're having to sell your asset, but you're only going to keep a small portion of the money in order to bail out other assets.
So I'm cutting back. Why? Because I'm spending $5 million a year more in interest payments.
$5 million.
How'd you like to shell out a $400,000 a month or $500,000 a month extra every month that you normally wouldn't have to, that you'd be stashing away in the bank and putting in tax-free muni bonds at 5% tax-free? That's, Anyway, the point is...
So that's the problem in a nutshell. His play money's gone. It's going straight to the bank. All my students, I told every one of them, said, you got anything you want to get rid of it now. Get rid of it now if you don't plan on keeping it, because you could see it was already starting to creep up just a little bit. Things were, inflation was going up. And so you knew it was coming. All my loans I locked into fixed rates, where prior to this, I had, the game of keeping them variable. And that served me well, especially through the, 2010.
I don't have to worry. There is the banks are pretending that you don't have covenants. Believe that? And I've never seen it happen on Wall Street. I'm seeing it on CMBS loans. I'm seeing it on Wall Street money. They're pretending that everything's okay, but it's not. Because if the property has to go to today's interest rate and be reappraised, it can't cash flow the same debt ratio. It's not going to meet the proper, what's the word?
What, cash flow, debt obligation, whatever.
Right.
Yeah.
So basically, it's not going to praise out anymore today's interest rate.
Yeah, but couldn't the Federal Reserve do what they did with Silicon Valley Bank? And basically to say, hey, we're going to loan you money. You could pay out your people. Investors get screwed out of it, but none of the customers are affected. Couldn't they do the same thing with the bank and say, hey, for all these loans that come due,
doesn't matter. Nobody wants to go there.
Just extend
Somebody
it.
gets, and the people that get the people with the stock.
Or it could be the taxpayers.
And now you're talking the stock market. You know what's going to do to the stock market?
You want it to damage the stock market. You don't want it to damage the taxpayers.
Banks start closing up.
I don't know if they will. I think the Federal Reserve will want to.
How old were you in
maintain it.
2008?
18.
18?
Yeah.
You remember it, right?
I
You
do.
were a smart young guy.
Yeah.
A lot of banks went belly up. A lot of mergers came out of it, and it became a mess. But it caused opportunity. It's got to happen. It has to happen because that's the only way we get opportunity.
Yeah. So his situation's tough because Ben waited too long. He sees the writing on the wall. Things are going down, and he's going down with it. And I know he's going to be fine. He's got a lot of money. So, like I say, he's going to lose a lot of his net worth. He's going to lose a lot, but he's got a lot, so he'll be okay.
What?
I look at 2020 where they just threw money at the problem. They just
You can't
they
keep throwing
bought
money
the,
at the
they
problem.
in a way bought
They didn't do
themselves
it
out
that
of the
much. They only
mess.
did it a couple of banks because it just started. Then you know what they did? They backed away from the whole situation. They didn't want to keep doing it. You know why? Because they keep doing it, then it'll become a bigger mess. If they start looking at every bank right now, trying to make that bank look like they should, it'll be a giant disaster. I'm telling you, the banks, it's not that the loans are bad. They're bad when they have to be paid back.
Yeah, the loans are bad because the interest rate's high. That's what makes them bad.
When the money has to be paid back. So what they're doing now is they're just saying, don't pay us back. That's their solution to it right now. They don't care about the loan docs. They don't care about the agreement you have. They're just saying, oh, he's paying us. Let's keep paying and extend it. Okay, but if they have to go to today's rates and get reappraised,
And they have to go to today's rates because you can't play favors. The banks get destroyed. They can't do anything for me. Don't do for somebody else. In other words, you can get an extension, but you can't really get a break on the rate without jeopardizing the fact that you're now, just think about it. You have an obligation to treat everybody fairly. They're going to have to foreclose on the people that don't pay or can't pay.
It's going to hit the fan.
So
I'm
are
already
they?
seeing it.
So,
we're
they're
seeing
basically
it.
betting that interest rates are going to come down by
will
the
come
time
down
they
somewhat.
get,
They'll come down about the.
I don't think he is betting on it. He's saying I'm selling my stuff. He doesn't want to hang on through the tough times.
Fives and stable out, but we got to go through the whole president shit, and we have to go through a bunch of bullshit. And they're going to keep praying and delaying right now until the year is over. In 25, we should see some straighten out with the financial situation. Because sooner or later, people are going to say, I want my money back. Can't get your money back right now.
Yeah. So for the properties that you're listed on your website, they seem like they're priced a bit on the high end. Like I'm
They're
looking
priced
at
retail.
Let's take a look. This one looks like that's roughly 5%. I mean, this one looks terrible. This one looks terrible. This looks like close to a 9 cap right here. This looks, like the same one, I guess. It looks same, but about a 9 cap anyways. Here, it looks like about a 7 cap, right? So yeah, these are ridiculous. These are never going to work. They're never going to get that kind of money. This one's is getting in the ballpark. But again, because this is almost what the money costs. The money costs more than what this makes.
As if things were great, peachy keen, and everything was a perfect world. That's where you price assets like that at. Why? Because you got to understand, my world is a little different than the regular market. I'm strictly a 1031. There's a circle of people in this country that have utilized 1031s, and they don't want to pay back all the tax they deferred. Okay? They don't want to pay it. So they find themselves in a situation like I did. I sold $100 million or $90-some million of Starwood Capital. All right? I found myself in a situation. It could have been $20-30 million tax bill on that because my basis is so low because I've been 1031 for so long. If I go out and buy a $10 million building tomorrow, I don't get the basis of a $10 million. I probably get a basis of a $2 million. Okay? Because all that tax that I deferred, they don't forget about that shit. The government remembers that shit and your basis goes down. And then if you die, then you get a break. The only way, is to die. Anyway, the retail is safe havens. I went to the Home Depots, I went to the Lowe's, I went to the Walgreens, I went to all the safe haven properties that I knew they're going to get you a decent return. I bought some in the 6 caps, some in the 7 caps. Maybe some of my value added, and I rented up some space, and there's more value in them. And they're maxed out. It's the best you're going to do with them. I got.
And see, think about that. He's the best he can do with them. He's got 6-7 caps, and the money costs more than that to borrow.
Shopping centers, bring in a few million a month, gross. And then there's not a lot of expenses because, you cammed out. You cam back all the expenses. So retail could be a very safe haven if you're in a 1031 and the clock's ticking and you got to hurry up and buy something and you don't want to pay the government. Some guys go out and buy planes. I go out and buy triple nets. Like you heard, I don't want to, your friend Grant Cardone or Kevin and all these guys. They go out, they buy these big fancy planes right before the year is up because they don't want to pay. They get a tax write-off for it. That's fine. That's their thing. They need the planes. Me, I go out and buy a triple net and defer my gains from real estate into that.
So nice job, Graham and Joey from the Iced Coffee Hour. So the bottom line is, look, Ben held through at the worst of times. He should have refinanced or sold, and now he's jumping in to sell with a lot of other people. Like he said, everybody's trying to sell right now, and he's right. And they're offering very attractive deals compared to what they would have offered, say, a couple years ago. So he's got to deal with that. I hope, for his sake, that he gets kind of an angel, a 1031 investor comes along and wants to park money in his portfolio and take it over. But I don't think so. I doubt that's going to happen. I think he's going to really, really take it hard. He's going to get, he's going to take it in the shorts. Really, really tough. And a lot of people are. And I've been, shopping myself. And you got to be brutal. And if you want to make an offer on something right now, it's to your advantage as a buyer if you've got the money. So don't be afraid to offer far below what you even think they'll even accept, because it'll snap them into reality and you'll get to the bottom very quickly. So hey, thanks for watching, and please hit that subscribe button, hit that like button, and you'll always get my honest opinion here. But that's what you got to look for. And everybody right now, the best thing you can do, and this isn't served Ben very well, you got to make offers that make sense. Offers that make sense are going to be a bad offer. If you make an offer that makes sense on Ben's properties or anybody else's that's pretty much out there, they're not going to like it. It's not going to feel good, but have to do it. I started in interest rates that were 10% interest. I bought properties that cash flowed day one. I bought properties far under market, bought properties for $100,000, sold them for $200,000, bought a lot of little things, for $40,000, sold them for $55,000, $60,000. And the same thing, everybody's going to be fine. You just have to understand that, the interest rates just went up so fast. The wages haven't caught up with it. The wages have to catch up. and then this will all seem kind of normal. I tell you what, you wouldn't have made the mistakes that Ben made if you were in my class. That is for certain. So thanks for watching, everybody, and see y'all soon.
And listen, time is on a mission to eliminate all the snake oil and the fake gurus that fake y'all. He'll show you how to build an empire, starting with nothing but a desire. All you really need is a good mentor, not a used car bullshit. With time, you'll learn to crush it. Investing like Warren Buffett. With real estate, you cannot procrastinate. Everyone who hesitates is left at the starting gate. Hey, yo, so don't delay and join today. The mentorship and flip anything. USA, go.